that should be taken?
Yeah, obviously, it starts with the idea, as you explained, but then you really need to validate your idea, and you really need to be solving a use case, a problem for the insurance companies. And to really understand for that, it is important to find insurance company partners who are willing to take the journey with you as well. So you need to identify the problem, but then you need to work together to solve that problem. And in our case, we are on the pricing side of things, so we really need a good company who knows the actuarial side of things, working with our competitors, hopefully, so that we can identify the weaknesses in the sector and we can work with them to build on those and build a product that can solve their problems, at the same time solve a general problem in the industry. You also shouldn't be short-sighted with one company and solve only their problem, but it has to be a general problem. And where do you find these companies? They need to be willing to take the journey with you. And one good place to find them is an incubator or InsurTech hubs. Like in Germany's case, there are two InsurTech hubs. One is in InsurTech Hub Munich, one is in Köln, the InsurLab. We are partners in both, so many of the time you find companies with use cases, issues that you can team up. And once you team up with them, then you're able to co-develop the product with them, then it really is a good product that can really solve their needs. That would be my answer.
Yeah, thank you. And I think you're not in an easy market, on both sides. You have competitors that have seen a lot of venture capital flowing in. On the other hand, I think we have some actuaries with us here as well. It's not easy to convince them that actually should use your engine, right? Because they know better. Yeah. So it's an interesting topic. Maybe we can just move on to Nasir and talking a little bit, because you said 8 years you're on the market and obviously have been running marketing for Friday as well. So how do you validate it? There's an idea, there's a product, and how do you get this out to the market? How do you validate new products or product ideas in the market?
Right. So essentially, what we do is not so different from what you do when you start a company, right? So when you launch a new product, a new feature, or a new service, it's an idea that needs to be understood, validated. We use a concept called ICE, where every idea is first of all assessed on its impact to one of our key strategic metrics. This could be premium, this could be loss ratio improvement, whatever the case. So that's impact. Then there's confidence. How confident are the teams that this measure, this idea, is actually going to really unfold the effect, the impact that we hope it will. And then finally, how easy is it to implement? And then you multiply these three factors, and you come up with a number that allows you to kind of gauge whether this idea is valid or whether another idea, because obviously there's always plenty of ideas if you ask the teams on what to do, where to allocate your resources, what the best idea is. But then once you have identified the idea, to build on what you said, Cenk, you try to validate it by running smoke screens. You have focus groups. You try to qualify or recruit customers to come in and test the idea with them, user testing. And then finally, if all of those things work out, you launch the idea. But then when you launch the idea, it's you still have to MVP your way to success, right? So whenever we launch a new partner, a distribution partner, we don't go all in because you need to integrate with the partner. That requires a lot of effort and resources and money. So what we do is we take the sort of soft implementation approach until we figure out that this is actually working and it's worthwhile investing more.
Thank you. And I think it sounds logical, but I have seen in my own experience here and in some other places that it's not that easy to do, right? So I think the consequence of executing this way is the way how you reduce the risk and increase the level of success. Maybe moving on a little bit from identifying the first steps of a journey of an InsurTech to the next one, because you need to validate something, right? And if you have a validated product, at least, not necessarily business model, you come to the point where you need to raise money. So maybe I can go to Alvaro and Zeeshan on both of you, because you look emerging markets, you look globally InsurTech, you see a lot. So maybe what I'm interested, and I talked about it yesterday, and I want to come back to this again. I see a lot of founders that just had an idea, oh, I have this product, now I need to find my next VC. And I strongly believe that's the wrong approach. You try to touch it on the other panel. I think for each stage of life of a startup or InsurTech, there's certain capital needed. So I wanted to hear a little bit your experience on this, what you would say founders, what to do when.
Maybe I'll start. We focus primarily on the early stage, so I can comment on maybe how that life cycle happens on the earlier stages, and of course you'll have a lot of experience on the later stages, right? So I think broadly, a lot of the entrepreneurs here know what a VC looks for in an opportunity, right? It's the classic things that you hear in these conferences. It's the big market, it's the experienced founders, it's the unfair advantage and the defensible moat. All of these things need to be present in your pitch. But I think what can really separate some of the pitches from others can be, look, there's 99% of the pitches that I hear won't comply with absolutely all of these checkboxes that VCs often have. It won't be, you won't have maybe a lot of experience in the sector, or you might not be developing in the largest market as your home market, or there's a variety of things that might not fit exactly into all of these different checkboxes. And so often a good strategy to that, and I don't want to sound too much like Tony Robbins here, but it's taking some of these challenges and crafting opportunities out of them, right? And so preempting some of the things where you're lacking and saying these are an opportunity for you to grow is something that I like to see in a pitch, and kind of recognizing where some of those challenges lie for your particular business model, and saying, I need also the help from an investor to help me overcome some of these challenges. It can be a good fundraising strategy. And I'll give a very particular example, maybe from our own funding point of view. It's not only founders that often have to go out in fundraising, but it's also VCs that have to go out and fundraise. And look, we're a European fund that is investing in emerging markets. So always the first question that comes up is, what is a Mexican, Austrian, and an Indian doing in Africa and investing in Africa? What do they know about that market, right? And so often we preempt a bit this question by saying, look, yes, we know we are a Mexican, an Indian, and an Austrian raising a fund for emerging markets, but we have been part of emerging markets for the past 5 years. Or Mexico can look very similar to a Nigeria or an India back in the day, right? And so finding angles and poising these as opportunities can be a very successful kind of fundraising strategy. And it's about being having something to be remembered by. VCs see a lot of pitches every day, right? So it's having these kind of things to be remembered by can be a very successful fundraising strategy.
Just to build on what Alvaro mentioned, we typically look at a slightly later stage than that, and we are focused primarily on emerging markets. So based on what we see, I think the first advice to founders would be start early your fundraising journey. It's incredible the number of founders we come across that still are in the pre-2021 mindset. They think they can go out to market and raise their funding round within 6 months. That's very rare these days. So highly recommend starting early. Secondly, we come in at a stage where companies typically have some track record and numbers. So numbers are very relevant. The type of numbers that we look at have changed significantly now. There is, and this is something that was mentioned in other panels as well, right? There is a big move away from simply looking at growth, but also considering profitability very closely. A lot of investors are spending significantly longer time during their due diligence phase in understanding the unit economics of your business. And on top of that, how sustainable these unit economics are. So make sure that you have a clear understanding and a story around that. Thirdly, if you're going out to market and raising funds, make sure you have a clear strategy and execution plan around the use of funds that you're raising. This is extremely important because this is going to guide the kind of investors you want to target. Now, the stage that we typically target, we find that our InsurTechs find a lot of value in investors that do bring some expertise in insurance. And on top of that, such investors, the investors with a focus on insurance, tend to be a little bit more enduring when companies go through difficult times. And every company, every startup will have some difficult patches, right? Such investors really can be your allies in guiding you through these difficult times. So do not underestimate the value of that.
Thank you. And I think we really can have a lot of talks about this, and we talk with a lot of startups. We see, obviously, as QRC, the VP, a lot of startups. And we're helping, you have seen what we've done in the last days, startups to grow in different stages, from idea to growth stage startups that we have seen and will see on the stage. So I think the worst that I can see is not really the PowerPoint is bad or the founder has an idea but don't execute. The worst thing is, look, I need $1 million. And you ask, what do you do with this $1 million? It's like, marketing, product development, and that's like, no. You need to have a plan what you want to do, because if I write a check, you need to execute, but right away, tomorrow. Yeah. Moving to Eddie, and I think you said you built companies in your last insurance company, but you also have done a lot of investments for this company. And I really want to pick on this. CVC versus insurance. We are CVC, we don't have fund, but we do invest. I think we're one of the most active insurers in the region investing into InsurTechs. We have done this many, many years. So maybe, can you explain a bit how you felt when you have been a CVC investor versus what you do right now, because you have a different perspective?
Yeah, so first of all, I'll start by saying that either side wants to make money. So let's get that as a basic principle. CVCs don't invest just like VCs don't invest simply for the goodness of their heart, right? They want to make money. The difference really comes from a strategic integration standpoint. CVCs might look for particular companies where they have pain points, they cannot solve those pain points themselves, and they would rather go invest in a company, eventually maybe even own that company, that brings a solution to a problem that they face. That's probably the greatest strategic angle for a CVC versus a VC. The VCs are really looking at how do we make money off of this particular investment in a certain time period, whatever that time period might be. I would say, though, that for founders, and I look at this whether it's a CVC or a VC, one of the things you have to be really careful of is don't go after dumb money. And let me explain what dumb money means. Right? Dumb money simply focuses on numbers. Dumb money doesn't look at what your actual problem you're trying to solve. And if you don't make your numbers in a particular year, you might make them in the next year. Now, I'm not saying numbers are not important, but dumb money looks at numbers only. And that's what you have to be really careful of as a founder. You need people who understand what you're trying to solve. What's the gap in the market that you're trying to fill? And if you are missing your targets in a particular time frame, why are you missing them? Do we still believe in the premise? Are you still able to solve that problem, etc.? I've come across a number of startup companies who have really good ideas, super founders. Some of them might be repeat founders, but they're not able to keep their VCs in the game with them because they keep looking at short-term results. And particularly if you're starting off early, late stage might be a bit different, but if you're starting off early, you need to get smart money backing you, not dumb money backing you.
And I think this is where we talked about it before. Insurance and InsurTech is a little bit different because our cycles are longer, and the problem that need to be solved is almost impossible for an InsurTech to solve it alone. So we need this, not dumb money, but strategic partnerships. Yeah? And that's what we're trying to do. We have a couple of companies here that we believe we want to do more things. And I want to move back to you on this, strategic partnerships. How important is this to build a company on InsurTech, and how important it is as an investor to see that there's a certain partnership there? And I want to add, we had a couple of discussions in the last, look, I'm here 3 years, with startups actually say, yeah, I would like to work with you, Lars, but if you put money into me, what will GIG say? And I say, they will love it. Because if I put money into you, and it's not me, it's QC, right? That finally potentially put money put into you. We have done a market validation. And all the other VCs around us will follow us. And we have a lot of VCs with us, and we all talk to each other because they say, like, if QC is interested in one, then what is interesting there? Then maybe we just follow. So I just wanted to add this from our own perspective, because this is one discussion that we have, but maybe coming back, partnerships as investment criteria and partnerships to grow a company.
I believe very strongly in partnerships. Yes, you do run into that dilemma if one particular institution comes and backs you, particularly if it's a CVC, will others come in? But to Lars's point, you're trying to solve a problem. If you solve that problem and you create a name for yourself in that market as a problem solver, others will come in. I don't think you'll have a conflict of interest with others coming in. And partnership is also important, because if you are partnering with the right players in the market and they're big enough, you get a lot of benefits with that. You get distribution, you get resources, you get potential integration into that business if that's what you're looking for in the future. And then when you go out and market to other insurers, other third parties, you can say, look at this use case that I've had and how successful it has been. And also very importantly, you get a lot of data. Potentially, if you're solving a problem for an institutional insurance company, you'll get their data to play with. And you get faster solutions to market if you have established data. And that only comes from partnerships.
Yeah. I think data is the point, maybe coming back to thanks to you on this, right? Because you said you are partnered with InsurTech Labs in Germany and a couple of other places, because you know that you can provide partnerships and data and underwriting, pricing. And maybe can you talk a little bit about how you do this as a company and how it does help or hinder you in terms of growth?
I mean, there are a couple of partnerships that we try to leverage. One is the partnership with the insurance companies and the CVCs that come with it. Actually, today in my company, I have at least 3 CVCs that also have insurance companies invested into us. So we are able to leverage their data and the know-how and going to market with them. But another type of partnership is actually for companies like us, it's very important to go global, international, but do it fast. And for me to do it by myself, it's very challenging, even if I have the funds or the money and to put the people in every country and then, try to open an office, go to the companies. It is better to leverage an existing company who has such a reach in partnerships. For example, just to give you an idea, we have a very close partnership with SAP in Germany. Now, they're already working with many insurance companies and they open the door for us once we go to our clients. A very new partnership that we set up is with EY, because I'm more on the technology provider of things, but in our business, you need a lot of consultancy that goes with it. So they're able to open a lot of doors for us when we go to the clients together with the pricing side and the consultancy side, and they can introduce us to many clients who are looking for new ways of doing things, because they are the guys companies turn to ask for new technologies normally. So these kind of partnerships really help us leverage the reach and do it in a very fast way, because for us, time is the most expensive thing, very honestly. So that would be my answer.
And we are misusing your energy as an incumbent because we have a lot of time and a lot of processes. So we are not as fast as the startups. And that's a challenge. I wanted to come quickly back to maybe Alvaro. And I could ask the question to everybody, but I want everybody to talk a little bit about it. Looking into getting more international, it's one of the things that is really challenging in the InsurTech Life, right? And you have it. We are in France, and Fridays in France and in Germany. I'm born there, but it's really complicated to get one InsurTech cross-border. So what do you see in your fund, because you've done a lot of investment into this, what are the key 1 or 2 areas how to move actually to the next country?
Yeah, I think it's not necessarily a matter of if, it's a matter of when, right? Timing is a key perspective to any expansion, but particularly in InsurTech, because as you say, even from a Germany to a France, the market dynamic is super different, right? And if we're talking about distribution, in Germany, it's primarily broker driven. In France, it's primarily bank assurance driven, right? So it's and adapting your product to be able to manage those 2 different distribution channels can be very challenging. And so I think the key lies in what Cenk was talking about, right? It's establishing the right partnerships at the right time to have your partners help you take this product global, right? Or take this product maybe to 2 markets before you do global, right? And the other one is finding passportable products, right? Maybe there's a reason why pet insurance, for example, has done really well in Europe and cross-market. It's because it's a relatively nascent category, right, where distribution channels haven't necessarily been established yet. And therefore, you have kind of the world open to you to be able to distribute that as you please, right? But if you're dealing with a product that has been distributed by bancassurance and now you want to distribute it through brokers in a new market, it's going to be way more challenging, right? So it's about finding those right products to expand your business with, and finding the right partners to do it.
Thank you. And I think you just said passporting. We had on the other side of the room a panel discussion with regulation where passporting was the last question and we let it open, right? So in the area, this is really the thing that we need to do. But I agree, right? There are certain products, MRC, we have seen it on the stage today, they do this, right? So they have designed products that you actually can move from market to market. How do you do this, right? With partnerships locally and the reinsurance capacity that they bring in. Yes, Jim.
No, just a couple of thoughts to add on to this, right? I mean, it's very important to understand your market, your product, but also the business that you're in, right? If you're a broker or if you're a SaaS provider, sure, it is much easier for you to scale regionally or move outside your country. But if you are a risk carrier, the obstacles are significantly higher. I mean, you're a capital-intensive business. You might end up doing another fundraise if you want to move globally. Huh? There might be different capital requirements, regulatory requirements. So the due diligence end up being a lot more sophisticated. So just be on the watch out for that. And I can't stress enough on the point that Eddie and Alvaro made earlier about partnerships. Having the right partner, and this could be your investor very well, right? Have you introduced you to their portfolio overseas? That could be significant value for you. That's something we do at IFC very regularly. Happy to chat with anyone who's interested after the session.
Yeah, maybe we just stay with you because we're coming to the end of the session and the end of a life cycle is an exit, hopefully successful one, right? I think I wanted to talk with you, Zeeshan, on this first because you have invested globally and I wanted to see how you see companies prepare for the exit and how investor can facilitate an exit. And then I wanted to see a practical example, not that I know that you're exiting, but I think you're raising, Nasir, right, with Friday. So let's see what do you get. So maybe we can start with you on your investor perspective and we go to a startup perspective.
Sure. Lars, so our portfolio as it stands right now is a little bit far from exit, but the way but the thing is, as an investor, exit is the first thing you think about when you invest in a company, right? So we do have thoughts around this. Now, I think the first thing that we encourage our entrepreneurs to think about is for them to consider what kind of an exit, what's really their reason for an exit, right? If they want a complete separation from a business, perhaps that's where they need a full exit, right? And they perhaps they're doing this for personal reasons or they want to pursue another commercial project. If they feel that they need to bring in someone else to help them further build the business in a newer stage of its lifespan, then perhaps a partial exit or a structured exit might be a better option, right? So that's very helpful for investors to know in advance. Secondly, I think it's very important to be flexible in current times with the type of exit you're pursuing. It's incredible how many founders I meet. They express their aspirations for the IPO, right? And that's great, that's fantastic. But the reality is that the IPO market right now, it's still frozen. It's thawing a lot slower than what was expected. So it's very important to have a plan B and a plan C, of course, depending on what your time frame for the exit is. The third point around, if you are going to exit to a strategic, let's say, a corporate buyer, in that case, further to Eddie's point earlier, right, it's very important to have a clear understanding where you fit in the strategic buyer's business, because then it helps you position yourself a lot better. And that's where we as investors can help you introduce you to the right targets as well. And then finally, and this goes beyond InsurTech, the most important thing, especially in our markets, emerging markets, good governance. Can't stress enough. We see companies with good governance are able to command a premium. Yeah.
We leave it there. This is, I think, it's a perfect phrase. Yeah, so leave it there, and then we can discuss next year or in the private session in the fireside chat. Maybe Nasir, Friday. So you have built, or the company was built, starting as a spin-off somehow from an insurance company, a relevant insurance company in Switzerland. You went to the German market. You built a German market for them. But in the end, every time you need to raise, you always ask a question: what is the next step? I'm going back. Yeah. the mothership takes over everything, or I just don't do it anymore. There's the secondary option that I have, so the shares that business angels bought in the beginning. So I move them out and I do a capital cleaning. All those things you have to ask yourself if you're raising. Can you maybe a little bit enlighten the audience on how you think about this?
Right. So obviously there's different kinds of exit or liquidity events, and while IPO is my preferred one, but it's still a long way to go, as I think is the case for a lot of startups also here. So what you're looking at is essentially either a full-on acquisition, that could be the mothership, or that sort of acquiring the remaining stake, or that could be an external player, that could be a competitor, that could also be an insurance company from abroad trying to get a foothold in your markets where you operate. Or it could be just a change of control. And so you need to understand what are those options, what are likely scenarios where one of these options can actually materialize, and you need to understand your shareholder structure, your current investors very well. What is their investment horizon? How do you fit into their, especially when we're talking about CVCs, how do you fit into their strategy? How do you fit into their, if they're listed, growth and equity story, right? So those are all considerations. And so the way I look at it is I try to kind of almost ignore the word exit, and I'm just trying to really improve the business. I'm looking at it not driven by, okay, what's my next liquidity event, but how can I turn this company into really the leading and best InsurTech, and maybe even the best insurance company out there, as opposed to being driven by just the short-sighted exit.
And being the best investable company will draw everything, the other options, right?
Exactly.
Look, Cenk didn't give us the music, but actually it should have come the music, so we are out of our time. Thank you so much. It was a great honor to be on stage with you, and I would love to continue discussing. I'll get the audience as well. Thank you very much.
We hope you enjoyed the enriching discussion so far. Now, let's turn our attention to our next program. Under the banner of Inspiring Growth Stage Startup, WADA, we're about to witness the spark of innovation in the InsurTech sphere. We're thrilled to introduce our speaker, Ishaq Kothawala from WADA, who will take us on a journey through their inspiring growth stage startup story. Without further ado, let's hear from Ishaq Kothawala as WADA steps up to the stage for their InsurTech startup pitching session.
Hi, everyone. So my name is Ishaq, and I'm going to be talking about my InsurTech, but more than that, 80% of the time, I'll be talking about how AI will impact the life insurance. So WADA is an MGA from Pakistan and Saudi, and we are trying to promote life insurance. As an MGA, we see the entire life cycle of an insurance process, be it claims, be it distribution, be it underwriting, be it the technology. And AI, for me as an InsurTech, the insurance part is more important. For the last 5 generations, my great-great-grandfather started the first insurance company in Pakistan. And on every Eid lunch, since I was very small, we've been talking about insurance. So I've seen the life cycle of insurance, from filling the forms to the fax machines, and so from typewriter to issuing the policies digitally. And now we're talking about AI, and then now we're also talking about some takaful policies issued to blockchain. So solving the insurance part of the InsurTech is more important. That's the problem that we come up with. And the solution could be the technology and the AI. So, most of the people since yesterday have been talking about how AI can aid motor insurance and health insurance. So very, very simplistically putting, AI, what is AI? AI is just a lot of historical data of inputs and outputs, and then using the processing of computing to predict the future. So for example, like this is not a new thing. 100 years back, Einstein said, if you know, he was talking about AI without using the word AI, because he said, if you know the starting initial state of any physical form and know that evolution and the exposure of that physical form, you can with certainty predict the outcome. And so in life insurance, how is our life, let's talk about pricing. How is life insurance priced today? So basically it's underwriters and actuaries. I'm also an actuary. So what actuaries do is that for the last 100, 150 years, they've developed mortality tables, and they see how age-based and your gender affects the mortality. So very, very simplistic, deterministic mortality table. However, obviously, and famously, they say lives are homogeneous and motor insurance or any other assets are not homogeneous. I argue that it's the other way around. Actually, life is far more non-homogeneous. Every one of us, since birth, is exposed to different food, different culture, different genes, different exposure, different wind, different weather. We travel less. Some people workaholics, some people travel. So it's our emotional health, physical health, spiritual health. They all contribute to how long we will live. But however, there's still some, so in with the advent of quantum mechanics, it challenged Einstein, where he said you can predict everything with certainty. Quantum mechanics said that there is an inherent randomness in every single state. Even if you have all the data, you cannot predict everything. So you can't be God. You can be near that, but you cannot be that. So predicting life insurance, so unlike motor insurance and health insurance, where you have the claims in the same year or the 2 years, with life insurance, the actuarial mafia, I'm also an actuary, so they stay relevant because they've developed their tables for 100 years. So putting that AI, so you can take all the knowledge of what impacts the life through variables, through state data, to hospitals, to social media, through their credit card, to see how much they travel, what the work-life balance is, to census, to health surveys. But still, you cannot. So you can have the inputs, but you can't have the output of the AI. So for the output, you need to see an entire generation. It needs to be 80, 90 years of those input, and then having those outputs